Startup valuation versus established business valuation. Not all businesses are valued in the same way. A pre-revenue startup cannot be assessed using the same framework as a profitable, mature company. And a long-established business with stable cash flow is not valued purely on potential. Understanding the difference between startup valuation and established business valuation is essential, especially if you are raising capital, negotiating equity, or planning an exit. Established business valuation. Let's begin with established companies. These businesses typically have historical financial statements, predictable revenue streams, established customers, operating profit or positive cash flow. Because reliable financial data exists, valuation methods can rely heavily on measurable performance. The most commonly applied methods include discounted cash flow, projecting future cash flows based on historical trends and discounting them for risk. Market multiples, applying EBITDA or revenue multiples based on comparable companies. Asset-based valuation, particularly relevant where significant tangible assets exist. For established businesses, valuation is largely earnings-driven. Investors focus on profitability, margin stability, cash flow consistency, risk profile. The lower the uncertainty and the more predictable the performance, the stronger the valuation framework. Startup valuation. Startups are fundamentally different. Many startups are pre-profit, sometimes pre-revenue, operating in emerging markets, building traction rather than reporting stable earnings. Because financial history is limited, valuation becomes forward-looking and expectation-driven. Common startup-focused methods include the venture capital method, working backwards from an expected exit valuation; the Burkus method, assigning value to milestones such as team, prototype, and strategic relationships; the scorecard method, benchmarking against similar funded startups; risk factor summation, adjusting valuation based on structured risk assessment. Startup valuation focuses less on what has been earned and more on growth potential, market opportunity, team capability, product market fit, exit expectations. Risk levels are higher, and therefore return expectations are higher. The core difference: established businesses are valued primarily on performance. Startups are valued primarily on potential. Established companies rely on measurable cash flow and margins. Startups rely on projections, milestones, and market opportunity. But this does not mean one framework replaces another. Different methods are more reliable at different stages of a company's development, and different investors often prefer different analytical approaches. That is why professional valuations apply multiple methods and weight them appropriately based on relevance and data reliability. Viewing the business through several valuation lenses increases transparency, strengthens credibility, and reduces reliance on a single assumption. Practical illustration: consider two companies. Company A generates $2 million in annual profit with stable, predictable margins. Company B generates $250,000 in early revenue but is growing at 120% per year. Company A would typically rely more heavily on DCF and EBITDA multiples. Company B would likely rely more on venture capital methods and growth-adjusted market benchmarks. Both companies can still be analyzed using multiple methods, but the weighting and interpretation differ based on stage and data availability. That structured weighting is what makes a valuation defensible. Why this matters: if valuation frameworks are not aligned with company stage, negotiations can become distorted. Investors may challenge assumptions, founders may anchor expectations unrealistically, or lenders may question the credibility of the analysis. Professional valuations avoid this by selecting appropriate methods, applying multiple approaches, weighting results based on reliability, presenting a justified range rather than a single number. That structure builds confidence on both sides of the table. There is no universal formula that applies to every business. Valuation depends on stage, data quality, market conditions, and purpose. The strongest valuations recognize this and apply multiple frameworks to reflect it. If you would like to understand which valuation approaches apply to your business, you can try the free business valuation calculator at www.valuation4u.com. And if this was helpful, subscribe for more clear guidance on business valuation, fundraising, and strategic finance.